Hi everybody, welcome back to Fire with Dr. Ninja Turtle. What I'm doing is I am running a ChatGPT calculation of the return on equity for my properties. I don't know if it can do this, but I'm trying to feed it enough data where it can run a return on equity. Now, what is return on equity? Return on equity is real estate changes over time. And as properties appreciate and mortgages are paid down, return on equity is how much useful this property is as far as the returns on your cash. In short, what we're trying to figure out here is based on the rental income that I have coming in, how much of that is return on equity as a percentage. And for example, let's say that I have a property that is returning 3% or 4% of my equity. I might be ready to sell that property and invest that money into another property that gives me a higher return on my equity, such as 8% or 9%. That is the sweet spot. What I'm doing here is I have fed data into ChatGPT from not only the last 5 years, which gives them the idea of how the properties have changed, but also over the last 6 months. I want to know the occupancy percentage. I also want to know the annual appreciation estimate. So, how much are these properties growing each year? Now, I'm in a low growth area. I also have low cost properties. So, the appreciation should not be as high as a higher cost property. And then this is all from ChatGPT that they said also create one row per property and then a summary dashboard showing total portfolio value, total equity, total debt, total cash flow, portfolio return on investment, and return on investment ranking from highest to lowest property. And that's what you're watching. You're watching ChatGPT go through not only my raw data from the last 5 years, which ChatGPT generated, but also my data from the last 6 months of 2026, meaning my monthly income that I've gotten from my property managers on each property for this year. When you add all of that data together, along with how much I have in equity on each property, how much I owe on each mortgage on each property, I am hoping that ChatGPT will be able to write a script and tell me exactly what this is. Now, the last time it took 5 minutes. I'm going to check and see if it's done because it looks like it's done. No, it is still working because it says creating the task. Now, you'll see here that it will show software that it's writing, it will show the task that it's trying to do. Now, I am asking for a lot of heavy number crunching. And so we are going to see how ChatGPT can take all of this disparate, I say disparate, data and write software that can, one, read the Excel files and read the PDFs and then extrapolate how much annual income I'm getting per property, which is in the raw data, but also how much am I getting this year in the properties. Because I want to not only track what's happened in the last 5 years, which was fabulous in the last Excel file that I was given, I also now want to track everything month to month because I have one property that I'm ready to sell. I'm talking to a realtor right now about selling that one property. The hard part for me is that if I have 3 properties or 5 properties in one loan, I can't get the one property out that I might deem as a property to sell, a good candidate to sell or refinance. I can't pull out that one property from that multiple property loan unless I pay the bank whatever that percentage of the loan is. Example, I have a duplex that I would like to sell, I think. We're going to see what the data says. But I would have to give the bank $20,000 to get that duplex out of that loan. So I don't have the $20,000, so I can't pull the duplex out of the loan only to try to go and sell the duplex, because the duplex has appreciated in value, so it is worth at least 3 to 4 times as much as what I owe on it. However, sometimes you have to pay to play. And so I don't have the money to give the bank to get that property out of the loan. What I can do is I can wait until it's time to refinance the loan, and that means that we're waiting on interest rates to come down, which they are not coming down anytime soon. However, what I'm trying to do now is get a heads up and keep my eye out so that when interest rates come down and I start to refinance properties, and let's say I refinance a loan that has 5 properties in it, the loan may be so low that 4 of those properties may cover that loan. And the bank says, which of these properties do you want to pull out and just keep 4 in the loan? That's how I've ended up owning properties free and clear in the past. I didn't pay them off. I refinanced them, and the bank said, we don't need all of these properties for this loan. You can have this property or another property, choose which ones you want. We'll give you those properties free and clear, and we'll give you the loan on the remaining properties. That's how I've had free and clear properties. I haven't paid off anything. And so this is still going. So it's telling me to review the workbook. And so I will review this workbook, and I will come back and have another screen that tells you whether or not this workbook really worked. Thank you for watching Fire with Dr. Ninja Turtle. I'm coming back with a second additional part to this video, so I'm just going to merge the two together and go through this workbook and see if it really gives me the data, because I'm telling you, I threw the kitchen sink at ChatGPT. Welcome back to Fire with Dr. Ninja Turtle. You will not believe this, but ChatGPT, given all the various different files and data that I threw at it, was able to extrapolate and crunch the numbers. Now, it's showing that of my top 10 properties, that the cap rate, which is really good, is 13.2% on some properties. Now, my number one property has a return on equity of 39.4%. That is an excellent return on equity. We are going to look at my worst performing properties and see what their return on equity is as compared to my top 10 rankings. So what it did was it told me these 10 properties I need to keep. But next we're going to look at some of the other top 10 rankings as far as ones that it's recommending that I sell. Now what we're looking at are the ones with the highest maintenance cost. And now it is ranking the ones that I should sell. And it tells me this property has cost me $15,514 by the year 2025. Now this is cumulative over the 5 years of maintenance. And so it's saying that it recommends that I buy more, like the second one that has only 8,000 over the last 5 years, but I definitely sell the one that's ranked number 1. Also, the one that is ranked number 7, it's extrapolated the numbers and said, even though I have spent $1,565 on property number 7, I should sell that property. This is what I love about having ChatGPT look at the trend of the properties that I've owned for 5 years or 6 years. And then it will tell me not only this property should go, or this property should be on your radar as one of the first ones that you want to sell. Now let's look at some of the other data. We have looked at this particular chart before when I ran this, but now what I've added are the first 6 months of 2026. So not only is ChatGPT looking at how much my total income was, how much my total expenses were, how much my total net profit is. And so if you take my total income and you subtract the total expenses, that gives you the total net profit that I have to pay mortgages, to pay property taxes, to pay insurance. Now, as I pay off the mortgages, less and less of this net income and total net profit will have to go out of my pocket. I will get to keep more and more of it as the mortgages are paid off, which is why I'm going to use the snowball method and pay off one mortgage at a time, and preferably the ones that are in a loan by themselves. And then I'll start attacking the portfolios where I have 3 properties in a loan. So I just wanted to show you that all of this data that I just threw at ChatGPT, that you watched it create, it gave me not only the last 5 years, but the last 6 months. It is current up until the end of May, is what this is showing me. So it's saying that from 2025 until now, my actual maintenance expenses have gone down in 2026. I didn't realize that. For me, I only see the month to month maintenance expenses, and I will tell you, in the month of May, I had very high maintenance expenses with in relation to the income that I had coming in, even though it was less than it was in 2025. So 2025 seems to be my highest year of maintenance expenses. All I can do is hope that they continue to decrease as my net income continues to increase. So everything is on a positive trajectory in 2026 overall for the first 6 months. Let's look at the actual comparisons. Now, what you saw before were my top properties that I should keep. But what this is showing are my lowest valued properties, and they're not the lowest valued. What they are is the lowest return on equity. That's what we talked about in this video. And so even my lowest return in equity property, which is 4.6%, and I'm going to come back and just explain what is a good return on equity and what is an excellent return on equity before I finish the video, just so that we all know. But my lowest return on equity is 4.6%. It has a cap rate of 1.8%, which is extremely low. It has an annual appreciation. Now, this is an annual appreciation estimate of 28.1%. I have had a lot of properties that I bought very, very low back when COVID and low interest rates were happening. And I also used other properties to buy those properties. So I was not out of cash, any money to buy more properties. And that's why some of my properties have doubled in value, some have quadrupled in value over the past 6 years. It's just something I'm very blessed with, that I've had properties that had an outsized appreciation in the market. Also, this only recommended that I sell 2 of my properties based on the return on equity, because that's what this whole calculation was about. And those properties were not ranked as my lowest return on equity properties. They had a higher return on equity, but based on all of the different data that goes into it, maintenance, all of the different things, the price, the whether it's a 3-unit, a 2-unit, a single family, all of that data gets all of that data gets consolidated, and that's how we come up with these calculations. So basically, I have two properties to keep an eye on. Now, one, I'm trying to sell the one property that I have, but two, I'm also trying to keep an eye on which properties I should pull out of a portfolio if they should be pulled out. And also, I can check every single month and update this to see which properties trending over 2026 should be sold. Maybe they move in the rankings between June and December. So we're going to keep an eye on this, and I'm going to come back and end this video with explaining what is a good return on equity. Okay, I am now going to explain a good return on equity because I was wondering this myself. A good return on equity, ROE, for a rental property typically ranges between 8% and 12%, while 8% to 10% return on equity reflects strong, stable returns. Seasoned investors aim for 10 to 12% or higher, as it justifies the active effort and risk involved in managing real estate. So, as you can see, I have some properties that are lower than 10 to 12%. However, I have some properties that you saw at the very beginning of this video that are at 39% return on equity. So I have a lot of properties. My top 10 are doing much, much better than my lower five or six. So I think overall, I am doing quite well with my return on equity, and I do not need to sell any properties or do a 1031 exchange, but there are a couple of properties that ChatGPT is recommending that I sell. And trust me, I'm going to keep an eye on those properties. Thank you for joining Fire with Dr. Ninja Turtle. And remember, never let your past determine your future.